Hello, investors. Welcome to the September edition of the podcast. Today, we will discuss the policymakers' indications coming from the Jackson Hole Symposium that was held last month, its impact on markets, and the way forward. The most significant global economic event held last month was the Jackson Hole Symposium, where central banks and economists from over the world met to discuss the current economic conditions and economic policies. The highlight of the event was the much awaited Federal Reserve's view on the US monetary policy, which was extremely hawkish, although unexpected, but it was certainly hawkish. They gave a clear indication that combating inflation through sharper rate hikes is the top priority for the central bank. This may involve a weaker currency and job losses as well. It's a short-term pain that they're willing to tolerate to fight inflation. So inflation has clearly been the top priority, and at all costs, they will try to bring inflation down. What did this was this led to a recalibration of market expectations because markets was pricing in a less aggressive Fed policy because they thought that now the central bank will focus on growth, but central bank is prioritizing inflation. In the July Fed meeting, the central bank had earlier indicated that the quantum of hikes would now be data dependent, given the uncertainty on the growth front in the economy. And the July inflation print in the US was at 8.5%, which was lower than what consensus expected, and which was much lower than the 9.1 in the previous month. But the central bank chief, Powell, reiterated that the central bank will continue to raise interest rates to fight inflation. This led to international gold prices and the US equity markets correcting sharply, ending the month with 3% and 4% lower, respectively. US Treasury bonds also sold off, with the US benchmark 10-year yield approaching a 2-month high of 3.2%. Yields on the US 10-year tips, which suggests that, what is the break-even inflation rate, also moved up from the lows of 0.09% to 0.67%, yielding positive inflation adjusted rates. Closer home, domestic sentiment remains cautious as investors interpret hawkish policy signals to set the tone for the Central Bank of India, which will also likely be a little hawkish. Equity markets had a sharp slump right after the Fed comments at the symposium, but later recovered from the lows. Indian markets, if you look at, bucked the trend, with Sensex advancing by 3.6%, which outperformed the global peers. If you look at Indian markets, it has reasonably stable macros, domestically driven demand, strong banking system, and manageable inflation, which would help India stay on course in the medium to long term. Indian equities will remain to an extent vulnerable to rising global interest rates in the short term, though. Coming to the bond markets, we see very limited direct impact on Indian bonds from Fed tightening, as foreign holding of Indian bonds is very low. Yet, negative sentiment will have some bearing on the Indian markets as well, with the next RBI meeting scheduled at the end of September, which is right after the FOMC meeting, where a 75 basis point rate hike is widely expected. RBI is likely to adjust its policy rate higher. In spite of moderating domestic inflation, that will likely be on account of to keep the currency and bond yield differential under control and deter foreign investors from reallocating investments to US securities. The 10-year government bond yields are currently at 7.11%. We expect the long-term bond yields to continue to trade in a broader range of 7.1 to 7.5%. Short end of the curve will likely move higher in line with the repo rate up to 6% probably by the end of the year. This risk of yields moving up could spur some intermittent volatility in debt markets. With hopes of a Fed pivot anytime soon fading away, there was a flight of money to US dollar that caused the dollar index to breach the 109 on the upside after touching a 1-month low of 104 in August. The strengthening of the dollar led to the rupee depreciating by 0.4% last month. Given that dollar strength is further anticipated, the rupee may stay under pressure. Any RBI FX intervention could add to some stability or lessen the volatility in rupee. but rupee likely be under pressure given the strength in the dollar. Headwinds like the strengthening US dollar, rising bond yields, and tightening liquidity by the Fed will no doubt put pressure on gold, but the precious metal will remain relevant given the geopolitical tension, risk aversion, and overall commodity inflation that is likely to persist. On the domestic front, gold prices will be further supported by the depreciation in the rupee. Despite the Fed's current hawkishness, its conviction to tighten will eventually get tested when the economic growth shows a meaningful deterioration. As of now, the world's largest economy is showing subtle signs of slowing, with the GDP contraction by 0.6% in April-June quarter. And prior to that, it was 1.6% contraction in the first quarter. If you look at leading indicators like the S&P Global US Composite PMI, which registered 45 in August and 47.7 in July, it's been a second consecutive monthly decrease, suggesting a slowdown in business activity. If you look at the spread between the US 10-year bond and the 2-year bond, continues to be negative since July. That indicates that continued concerns among investors that the Fed's aggressive withdrawal of liquidity will push the economy into recession. But for now, the Fed will continue to hike for the rest of this year and probably in the first quarter of next year. Investors should thus brace for volatility, continue with their staggered purchases or SIPs, and stay invested in equities and gold with a medium to long-term horizon. Indian economy overall is very well poised for growth and should continue the cyclical recovery that's in place post-COVID. For one's debt allocation, investors can opt for lower duration funds like liquid funds to minimize impact of negative price changes and enable continuous deployment of their monies at high rates in this rising interest rate environment. So overall, liquid funds from a debt perspective and staggered purchases in equity and debt, I think would be a better strategy for investors. So with that view, I think hope this festive season brings in much auspiciousness to everyone, and hope that you kind of invest and save wisely and invest in Indian equity and gold and an asset allocation strategy that would work well for you over the long run. Thank you so much. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.